You know, if you've been watching the US stock market lately, you might think everything is perfectly fine. It's been incredibly calm. But just beneath that calm surface, there's another market, a much bigger one, that's starting to send a very different message. Today, we're going to tune into that frequency and hear what the bond market is trying to tell us about the economy.
There's a saying in the finance world, while the stock market is focused on today's headlines, the bond market is busy reading the next chapter. See, bond investors are obsessed with one thing: a company's ability to pay back its debts. And that gives you a much deeper, more fundamental view of its actual health. So, what does that next chapter look like?
On the surface, everything looks great in the stock market. Just look at the VIX index. It's often called the fear gauge. Right now, it's hovering near its lowest point since January of last year. What that tells us is that stock investors are feeling really positive. They see almost no risk on the horizon.
But is that really the whole story? That calm might just be a little deceiving. You know, whenever pretty much everyone agrees that things are great, well, that's often the perfect time to start looking for signs that suggest maybe they're not. And those signs are definitely starting to show up.
Okay, let's start with the big picture of the economy. Right now, we're seeing this really fascinating split between two different kinds of economic data, what we call hard data versus soft data.
So, what's the difference? Well, think of it this way. Hard data measures what's already happened, things like official job reports or GDP numbers. It's the concrete, here-and-now reality. Soft data, on the other hand, is all about the future. It's based on surveys that ask CEOs and regular consumers how they feel about the next few months. One is kind of like looking in the rearview mirror, while the other is looking out the windshield.
And here is where we see the disconnect. The hard data, the rearview mirror, shows an economy that's doing just fine. It's holding up. But that soft data, the view through the windshield, has been dropping steadily since last September. In other words, the very people who run businesses and spend the money are getting more and more worried about what's coming, even if today's numbers look pretty good. Now let's zoom in a little. We're going to focus on the hottest area of the market right now, artificial intelligence. And here, this divergence between what stock investors see and what bond investors see is, well, it's even more striking. Okay, before we dive in, we just need to quickly get our heads around one key idea: the corporate bond spread. The easiest way to think about it is as a risk premium. It's the extra interest you get paid for taking on the risk of lending to a company instead of the super safe US government. So if that spread gets wider, it means bond investors see more risk, and they're demanding to be paid more for it. Simple as that.
Now here's what's so fascinating. Normally, when a company's stock is doing great, its risk should be seen as going down, right? Which means its bond spread should get narrower or tighter. But look at what's been happening with these AI companies. Their stock prices are sky high, but at the exact same time, their bond spreads are widening. Bond investors are seeing more risk. That's a flat-out contradiction.
Let me just be crystal clear about this. Since the last quarter of last year, you've had two groups of really smart investors looking at the exact same AI companies, and they are coming to completely opposite conclusions. Stock investors are seeing nothing but growth and opportunity. But bond investors, the ones focused only on financial stability, are seeing risk that is steadily going up.
And this isn't just some minor disagreement we're talking about. This is a truly historic shift in how the market perceives risk in what has been the safest, most dominant part of the market for more than a decade.
15 years. For 15 years, a certain rule has been true in the bond market when it came to the tech sector. But that rule has just been broken.
For the last decade and a half, big tech companies were seen as the gold standard. They were safer than your average company, so their bond spreads were always lower than the market average. But late last year, that completely flipped. For the first time in 15 years, the bond market is now saying that tech companies are riskier than the average US corporation.
And this didn't just happen overnight. The warning signs started to appear in the middle of last year, first with the riskiest tech bonds, the ones called high yield. Then, by the end of the year, that worry had spread to the entire sector, including the safest investment-grade tech giants. This tells you it's a systemic shift in how the bond pros see the entire tech landscape.
So the bond market is clearly worried about the future of tech and the broader economy. In this view, while it gets reinforced when we pull the lens back and look at the bigger picture, especially for the average American household whose spending is really the engine of the whole US economy.
To really understand what's happening, you have to know about this idea of a K-shaped recovery. It basically means the economy is splitting into two. The top arm of that K is shooting upwards. That's high-income folks and people who own assets. They're doing great. But the bottom arm of the K is pointing down. That's for the middle and lower income households who are actually falling behind. And you can see this split clear as day in the data. The S&P 500, which mostly reflects the wealth of that top arm, just keeps climbing. But the Michigan Consumer Sentiment Index, which measures how the average family feels, it's near a 10-year low. And this matters a lot, because consumer spending makes up 2/3 of the entire U.S. economy. If most consumers are struggling, you have to ask, how long can the good times really last?
Okay, finally, let's look at one of the most respected, long-term ways to value the market, famously championed by Warren Buffett. It's a really simple idea. The stock market's total value shouldn't get too far out of line with the country's actual economic output, its GDP.
And right now, that ratio is sitting at 2.17. Now, just to give you some perspective, the historical average over the last few decades is more like 1.5. So what that means is the U.S. stock market is currently at one of its most expensive, most overvalued points in the last 20 years. This kind of extreme valuation lines up perfectly with the cautious story that the bond market is telling us. It really suggests that stock prices may have gotten detached from the underlying economic reality.
So while the stock market is cheering and celebrating the calm, the bond market is over there quietly pricing in more and more risk. Risk in the economy, risk in the tech sector, and risk in that growing divide between the market and the average person. So it really leaves us with one critical question to think about.